So from Dave S., he says, you often discuss an investment in a bulletproof status and how valuable that is. That's referring to more of the married put position we were just talking about. Oh, not there. But the married put position we were talking about. The actual position in Fusion is bulletproof, so let me edit position again. We're going to lower our cost basis, our effective cost per share on the stock down to that $43 range, I think it is. Okay. All right, and I think that puts us in bulletproof status, but the question goes on. I usually find, though, that I should be comparing not only the current risk and possibility of making an adjustment or using an income method. As of now, I would probably sell the stocks at 53. I'd sell an October, November 55 call against this position, which I have right now. In that case, to further lower the risk and get more bulletproof status. Okay. But David wants to know, should I also be comparing to current liquidation value? It's true that making an adjustment or using an income method could make a particular position bulletproof, but that doesn't mean it can't lose money from today's value. Am I thinking about this correctly? Could you discuss this? Okay. You gave me an example, but unfortunately, when I had to print it out so I couldn't have the email open, the graph printed out too small, the screenshot printed out too small. I saw it was in a NVIDIA position, but I didn't really see it. So what we're going to talk about here is some of the concepts that's discussed in the blueprint. The full work that describes our preferred structure for the married put, the full use of the 12 different income methods, how we apply that to our trades, and more. Now, let's take a look at the graph of that ally position. Now that I've adjusted it, it's not the actual position in this case. The actual position is bulletproof. Okay, so we've got a 4.4% bulletproof position here. I think I'm 1% bulletproof status, 1.4% bulletproof status on the current ally position that has a sold call on it, and earnings come out after October expiration. That's why I'm still holding the position. But let me talk about that for a minute. David is correct in the sense that now that I have a bulletproof position, the liquidation value at any time between now and expiration should be higher. That 4.4 bulletproof status all the way to January of 2022 is the worst case scenario if ally stays below 55 going through that. The liquidation value here will be higher, so I might be at 7%, 6% right now. But that is an important question that you ask, and it is an important comment that you ask as well. And what I mean by that, David, is yes, I would look at the liquidation value because we all have personal targets for what we're using in a given strategy in our portfolios. And so when I'm in a position that I've bulletproofed, and this one, could I bulletproof it more if I rolled up the put? Yes. Could I bulletproof it more if I used income method number 3 and moved the January 55 put that I have and already paid for, brought into a cheaper price, so for say November, still crossing the earnings with a more bulletproof position and still upside profit? Yes. But is it worth it in those cases? So let's go to position analysis. Let's see where we are right now. Worst case scenario is a profit of 4.4% if I hold it all the way to January expiration, make no other adjustments, and the stock's still below $55. That's the absolute worst I could do on this trade. Liquidation right now is 9.7%. Yeah, I know I kind of cheated a little bit with the numbers. That's not my liquidation right now in the actual ally position in the Fusion portfolio. But if I'm considering an income method now, David, where I might sell that 55 call to get a little bit more premium, I might roll in the put using income method number 3, for example, to get a lower maximum risk. Here's an opportunity for income method number 6, the bear call spread inside the nested structure, which gives me a better bulletproof status as well. So these are things that I could consider. But if I'm comfortable with the return I already have right now at liquidation, I've met my goals for the time frame I've been in the position for this trade, I may just close the position out. I may liquidate now, even though I could get it to bulletproof status. Here's another example. Let's say this position wasn't bulletproof right now. I was still carrying a 2% risk or 4% risk in your example. My liquidation right now is 10% or 11% after 70 days, 80 days, maybe not that high. Okay, let's say 110 days. All right. So I could liquidate for 11% now, or I could bulletproof to a 2% guaranteed profit still out to January. But what am I risking? Now I'm risking in that case, if I did make that adjustment, let's say I sell this November 55 call and get a new risk, bulletproof status is 7.4%. If it turns out at November that I'm just at the peak of the short call strike price in this case, right here for a 7.4% return, if it's higher, I'm not making as much. And if it's lower, well, I'm still making, I'm sorry, I could make 13% in that case. But if the stock falls and I make 7.4%, it goes against me with the earnings after selling this call and I only make 7.4%, David, wouldn't I be better now taking a 9.7% return? If I've hit my goals and I'm no longer overly bullish on this position, then yes, I would consider that. And I would look at the liquidation value right now on my married put positions prior to doing an income method. I look at the simulate trade feature to see what is the best case scenario, worst case scenario with this adjustment that I'm going to make. In this case, I still might do it. If I think Ally is going to be right around $55 or $56, potentially making a 13% return on the position in that case, if it's right around this strike price in the next 40 days or so, or 60 days, I believe it is, I might take that chance. What's the risk? If it falls drastically down to 40, or if it goes really high up to 70, then I might only make 7.4% return where I can make 9.7% right now by liquidating if I've met my goals. In my example, and I didn't look at NVIDIA, but we can look at that real quick, not the trade itself, but just the stock. In the example that we're showing here that we have in the Fusion portfolio, I am staying in the Ally position. It's not that I am overly bullish on this position, but I'm bulletproof through January. I know what my liquidation value is right now, and I could take that off the table. But I have earnings coming up, I believe, on the 19th or the 20th of October for Ally Financial. So I'm staying through the earnings to see what happens. If I get a jump and it goes up to 57 or 58, I could bulletproof it more. I can get more income at higher strike prices. I can continue the trade, and I'd have a different take and sentiment on that position, David. If the earnings disappoint and it falls, the worst I could do is have the bulletproof return. I could consider liquidating right now for a higher return, but because I still have the January put, and it's not an October put or it's not a November put that's going to be affected by the earnings report coming out, I still would have a higher return than the worst case scenario bulletproof status. So it's worth staying through in those scenarios. If you've hit your targets, your sentiment on the stock has changed, you don't want to do an income method right now to bulletproof it, absolutely. When I go here, I check this number first. Even in my other spread positions, calendar spreads, even covered calls, collars, I see where my liquidation is right now compared to the future expiration value. That's worst case scenario, 4.4% profit, January expiration if the stock's still below 55. And then I use that simulate trade feature so I can see best and worst case scenario of the new adjustment with in mind exactly what I have right now, that 9.7% liquidation, so I can better determine, is it best to take it off the table now if I've hit my goals and move on? What is my sentiment for the stock going forward? And then, of course, at that point, making the decision, what is best for you personally in your account. And as I mentioned, of course, all of that information, there is a whole section on exiting the RPM, of course. Oh, I didn't want to go to search. Yeah, in the blueprint, how to use the 12 different income methods and comparison, as well as the full course on using limited risk trading techniques. David, I hope that answers your question there regarding evaluating rollout opportunities and income methods in that case on a bulletproof or non-bulletproof position, which we can go forward as well. And David says, thanks, good discussion. That go forward thinking is similar to making an initial investment. That's what we've talked about before in other topics. You're absolutely right. And what do I mean by that, other topics? A lot of times in these webinars, and I think we have a question coming up here, there's a question about, I'm in a covered call position and the stock moved against me. Should I evaluate rolling down, or should I roll up the position? And when we look at the rollout opportunities here for a covered call, whether it's rolling down or rolling up, what I have to ask myself when I see that new potential return on the position, I want to ask myself, is that return for the covered call match my trading goals? In other words, if I'm rolling out 25 to 30 days and I'm only increasing the return I have right now by 0.8 or 0.4%, and my trading plan is to get 1.5 to 2% every 25 to 30 days, I'm not rolling for the sake of rolling. I'm looking at the position fresh again, just as you mentioned, David, as we evaluated here. And I'm saying that before I do this roll, would I open this as a covered call position now, seeing what the stock has done? If I do this income method now to bulletproof this position further, what is the before and after picture under simulate trade? Do I still have that sentiment for this stock going forward, or should I be better off now just taking it off the table, taking my profit and look for a new position that I have a stronger bullish sentiment for this strategy in my portfolio? Absolutely. You always want to reevaluate the position almost new, looking forward thinking about, is it worth it to just stay in this position and keep adjusting, or could your money be used maybe in somewhere of a different place that looks like a trend that's giving you more profit for the strategy you're employing right now? 100%, David, absolutely. So thank you for mentioning that and bringing it up as well. Very important in any strategy.